Okay, you're welcome to day 8. This is the second day for our module on financial analysis. And today we're going to be looking at bank reconciliation. Okay, I'm sure most of us have not heard about this before. The first time I heard the word reconciliation, I was like, who am I reconciling with? Who did I wrong? So let us see what it actually means. So bank reconciliation is a process to compare your cash book with the bank statement. Okay, so it helps to ensure all transactions are accurate and recorded. Detects differences, errors, or unauthorized transactions. Because when you are working in a big organization and you do financial disbursements through the banks, of course, your bank also records, right? And you have to record too in your maybe accounting software. So you have to be able to check at the end of the month if what is in the bank is actually what you wrote down that you transacted, right? That's what accountants will always say. I want to go to the bank and get the bank statement, or it has to be emailed to us so that they can check. So it's very, very important. So it verifies the accuracy of your financial records and helps identify fraud or unauthorized transactions required for audits and financial accountability. So when third-party monitoring comes, or when your funder comes to audit, they have to check your bank statements, okay? And it prevents budgeting and planning errors. So this is an example of a bank statement. It gives you the exact dates and what actually happened. Was it cash received or was payment done? So the bank gives you all of that. I think most of us who have bank accounts, at the end of the month, we always receive an email, and that's our bank statement, but most of us never open that email. So I think it is time for you to open that email when it comes, and then you check, and then we see how these things work, okay? All right, so common differences between the statement and the cash book. Outstanding checks, deposits in transit, bank fees or interest. You can make a deposit and it's still on its way, right? Because when you do a deposit, it takes about 72 hours to reach the bank of the other person. So when some of these things are still pending, you can have differences between your bank statement and your cash book. Bank fees or interest, direct credit, like donor transfer, and errors by bank or organization. The bank can still make an error, or you yourself can make errors. So this can lead to differences in your cash book and your bank statement. So when you have such differences, you can begin to check. Are there checks that you should have that have not been cashed? Maybe you issued a check that has not been cashed, and so the money is still in your bank account, but it's already shown in your cash book that it was already disbursed. So you got to check all of that, okay? So the balance per bank statement plus deposits in transit, of course, minus outstanding checks plus or minus bank errors should give you a balance per book. So this is for big accountants, which you may not need to worry about this if you're not an accountant. But when we get into practicals, you will just worry about tracking your own sales, your revenue, your expenses, and then you're getting your money at the end of the month. You see which product in your company has the highest sales, which product in your company is ordered the most. We'll see that in the third day when we are doing our practicals. All right. Okay. So now steps in doing a bank reconciliation. Maybe I'm blocking you here. So steps in doing a bank reconciliation, you get to the bank statement, you compare it with your cash book. No, this is not really necessary for first timers, those who do not learn financial analysis for their day-to-day analysis. But you can always maybe get into, like, if you have an MBA in management, someday you might want to do some checks or help somebody, and you may need to get this knowledge used, okay? So you compare, you get a bank statement. Like I said, you can go to the bank and you get it, or you can get it through email. You compare it with your cash book, you know the missing, the incorrect, or the duplicate entries, and then you adjust for fees, deposits, errors at your end. And if it's the error from the bank, you can get to the bank for correction, okay? And then you prepare reconciliation statement and you review and you approve it. Maybe you have to sign, the chief accountant has to sign, or the chief finance officer in the organization. All right, so very important. Sample reconciliation statement. Cash book closing balance 1.2 million. deposit in transit 100,000, outstanding checks 150, bank charges 5,000, then adjusted balance, you have all of this, right? So if you take 1.2 million, subtract this one, then you subtract this one, and then you subtract this one too. You're gonna have this, right? So it's very, very important for you to do this. This is mostly for accountants. So activity, you try it yourself. Your NGO's cash book shows a closing balance of 900,000. The bank statement has deposit in transit 100,000, and outstanding check is 550,000. Bank fee is 5,000. So calculate the adjusted bank balance. Share your answer in the chat. So share your answer in the WhatsApp forum. All right. If you're following this on YouTube, you can share your answer in the comment section. So you try it yourself. It's very important. Like I always say, if you study and you don't practice, you are practicing knowledge obesity. So don't get this knowledge and get it stacking in your brain. Unleash it by practicing. Okay. Yeah. All right. So this is very important. Ledger, profit and loss account. Very, very important. I'm going to say this too. So you can always have a ledger. Although at Ace Analytics, we're advising you to just use your smartphone. We can build all these things for you in your Google Sheet, and you use your smartphone to enter your data. But it's still good to use your ledger because you can have issues with your gadget, right? So you can actually use your ledger and then you transfer it to your smartphone or to your computer at the end of the week. That can be the work of your data clerk or your salesperson, or your accountant, if you're in a big company, right? So a ledger, so what is a ledger? A ledger is a financial record where transactions are categorized and recorded by account. For example, cash, salaries, income. Like we said earlier in the first part of this lesson, if you've not watched it, you can go and watch the first part of this lesson where we saw the various, how you can categorize your various income sources, right? And your various expenses sources. It's very important. So it is the foundation of all financial reporting. So the source document must identify transactions, okay? Then maybe journals, where you capture them. Then your ledger now is the center point, like your master sheet. For those of us who use Excel, your master sheet pulls data from all those sources. And then you now have the trial balance, the income statement, and the balance sheet. For those of us who did economics at the secondary level, we know about the balance sheet. I knew of this before I did an MBA. So, but with the MBA, I was able to calculate, the balance sheet, all of that, bringing data from the income statement, bringing information from other financial statements to give you a balance sheet, very important. So you have your sales ledger, which track customer payments or the debtors. You have your purchase ledger, track supplier payments. Most of us go to the market and buy, but we never track it. Very, very bad, very poor data management. General ledger now contains everything, all other accounts, income, expense, and assets. So you're supposed to have a book. When somebody buys from you and doesn't pay, that person is your debtor. So it's a debtor. So you're supposed to record that money in a debtor's ledger, right? And then if you buy, your supplier comes and supplies you goods, and you've not paid, all right? You are a creditor. That's your creditor. And you are a debtor. You are a debtor, but that person is your creditor. So you have to register that in creditor's book because the person is your creditor and you have not yet paid. All right. So it's always about the other person, not about you. That's what make most people confused. So the debtor's book here is not because you are the debtor, but it's someone owes you. Then the creditor here, you're not the creditor. You didn't give out anything, but you received something. So it's about the person who gave you. All right. Very easy. So general ledger contains all other accounts like your income, your expense, your asset, and all that. So it's very important to have these three registers if you're starting. You should be able to have your debtors register, creditors register, and your general ledger. And of course, you should also have the stock book, right? Stock book. If you store how things in your warehouse, you should have a stock register too. That's also very important. But with Excel now, you don't need to have all of that. You can just prepare those sheets in Excel. And when your stock comes in, you register it in your stock register in your stock sheet in Excel. And as you're selling it, the software that automatically deduct from the stock register. And of course, each day you can know how many goods are left in your stock, right? Okay. So you have something like this, which is very easy. And many people don't do it. You just write a date and then you describe what happened. Okay. Opening balance, I had 50K, 500K, 500,000. Then credit. Nothing actually came in. So I'm left with that. And the next day I paid my rent. So something went out, right? Something went out. So I gave money maybe to my landlord. So I credited my landlord. So what happens? 400,000 is left. Most people always get confused in this case because, like you see here, this is me paying rent. But why is it credit? All right. So it's about the other person. Just put it that way. It's about the other person. So money leaves me, but it gives. What does the other person do? The other person receives. If you want to put it that way. So you credit the other person. Just put it that way. Simple. Don't go too deep. You may just get confused. Okay. Just like the bank. Okay. When the bank, what you call credit in the bank is actually money that has left you and gone to the bank. But you think it's your account, so it's a credit. But the money left you, didn't it? You went and deposited money in the bank, right? But it's called crediting because you gave it to the bank. Then now, when the bank, when money leaves, when you go and withdraw money from the bank is a bank debit. So what happens? You get money. So debit is you getting money and the bank losing it. So it's always about the other person. Just put it that way, and it's going to be easy for you. If you're into finance, if you're into finance, don't worry about some what terms. They won't disturb you. Don't bother about them. Good. Donation received. You see, I received something, but it's under debit. So it's about the other person. So donation, somebody gave me something. So that person had to debit their account for me to have something. All right. So that's it. Very easy. So we're going to check this when we do our on the third day. We're going to have practicals, and it's going to be very easy. But we'll focus more on you tracking your income as a business owner, how you can set up your income, your ledgers, and your linear or formulas. So it's going to be very easy. So don't worry too much about these technical terms here, except you're into finance, you're an accountant, and you're confused about these terms. Don't worry so much. So you have an example here of a profit and loss account. So grants, donations, then expenses, and then at the end of the day, you see what you get. All right. Good. So this is another exercise for you. So you paid your rent 100,000, donations came in 300,000, and the salaries were paid 150,000. So create a mini ledger, prepare a basic profit and loss account. You can just draft this in your book, snap it and send to the chat. Let us see how far you understand the lesson of today. Okay. All right. Financial reports, very important for accountants and, what are financial reports? Financial reports are formal records summarizing financial activities. The purpose is for decision making, transparency, and accountability. Very important. When it comes to finance, there must be accountability. People have died because of accountability. So if you're working and touching money, please be very accountable. Used by organizations, businesses, and non-profits, and of course, used by auditing teams, used by third-party monitors, and all that for auditing. So it's very, very important. All right, so just for summary's sake, we have the balance sheet, which is a snapshot of your assets, liabilities, and equity at a particular point in time. Assets are what you have, liabilities are what you owe, and equity is what your stakeholders or your investors have, right? Because it's not yours, but it's not a liability, it's not your asset, it's their money, so it's equity. Profit and loss statement, income versus expense over time. Cash flow statement, this is the one that I like so much because I have to touch money, touch cash. Then the budget versus actual report, very important because in project management, you can budget, or in anything in finance, you can budget and then you use more than or less than what you spend. So you should always have a report on that. Donor and grants report. Donors as grant reports, very important for NGOs. So this is important, just a refresher for those of us into humanitarian fees. Who uses financial reports and why? Managers use it for planning. Donors use it for accountability. They give you their money, you have to be accountable. Board members use it for oversight to ensure that you're not stealing, okay? To make decisions. Auditors use it to audit, right? To verify if what you're saying that took place actually took place. You told us that you send money to a supplier through the bank account and there's no proof in your bank statement, then you didn't do it. Right? And of course, government use it for compliance because governments also audit banks and they need all of this. There are laws, financial laws, just to stay in good terms with the law. Very important. So it's not for nothing that all these things are done, okay? So steps in preparing financial reports: collect your documents, record transactions in journals. You do this on a daily basis, okay? You post to ledger on a daily basis, prepare trial balance. Then at the end of the month or whenever it's needed in a quarter, you can now do your analysis as a financial analyst and get your reports, whether it's income statement, cash flow, statement of cash flow, balance sheet, whichever, you can have that, okay? So why financial reports? Why do they matter? They build trust with donors and stakeholders. They help detect fraud or mismanagement, inform financial decisions and project evaluations required for audits and renewals, and ensure transparency. Very important. It's a simple exercise that you can actually use so you can analyze should be simple report, okay? So identify one positive performance, identify one area of concern, suggest the cause or variance. Policy performance. So we have trainings here. We have a budget of 100,000 and then we actually spend 950. So we have a variance of 50. All right. Well, so this 1 million, and we spend 150,000. So we have to gain 50,000. All right. Transport, budgeted 600,000 and then you spend 750. So you went above. So there was an additional 150 that came in. That's why you have this plus here, right? Then the total 1.6 million, you spend 1.7 million, you spend additional 100,000. All right. So what could be the cost of this additional 150? Maybe transportation costs went up because of maybe increase in fuel. All right. Or maybe it was late in the evening, you have to hire a car for that. Just think out of the box and give the possible reasons for this. Because when this happens, you have to explain to the auditor. You may make a note explaining why this was above the budget. This was below the budget. Maybe you have to explain, maybe prices went down when you went to the market, or the number of people you had to buy things for dropped, things like that. Very important. Thank you. So we're going to meet you in the next lesson where we are going to do practicals. All right? Good. Okay.